Hello and welcome to another episode of Darwin Investors. I did it. I went green for the year. I actually went green on Thursday, but it carried through all the way through Friday, despite the fact that we got good unemployment data, which is kind of an oxymoron, really strange. But I'm going to go ahead and give my bullish thesis about why I think the market is bottomed and why I think that there's a lot greener pastures going ahead. I'm going to give some information on housing data that I don't think you're going to find anywhere else. It's just an observation that I made. I'm going to give some data on automotive sales that I think you're going to find interesting, and also some commodity information that you might find interesting as well. Before I get started, I got to give a shout out to my sponsor real quick, and that is beer. Got a good taste. All right, let's get into this. Right. So the very first reason why I'm so bullish on this market is because retail is back. And when we're in charge, we tend to drive this market upward. And you can tell because some of the equities that we tend to like seem to be going up right now. Even if they report bad earnings, they still will go up right now. And the second reason why I'm bullish here has to do with this unemployment data. So it's good. High employment rates are good. Low unemployment is good. So payrolls increased 528,000 in July. That was a lot better than the 258,000 that was expected. That gives us an unemployment rate of 3.5%. That's the best since 1969, which is pretty astonishing considering that in 1969, if you were between say 18 and 25 and you didn't have a job and you weren't going to school, you had a job with the United States Army. And so we're down at those levels right now. Now, this was a bit of a surprise because if you look at the initial jobless claims that came out on the week ended July 30th, the unemployment benefits rose by 6,000 to 260,000 when the market was only expecting 259,000. And if you look at this chart here, 260,000 seems to be about the highest since probably November of 2021. So despite the fact that our jobless claims seem to be inching upward, our unemployment rate seems to be inching downward. So that seems to be really strange. The only thing I can come up with is that perhaps people that have a job are getting another job. Maybe things are that bad that you have to get two jobs in order to afford things right now. But I can't come up with any other reason why initial jobless claims would go up and the unemployment rate would go down. But a low unemployment rate was going to be considered to be bad. And it was said that a strong unemployment rate was deliver a jolt to the Dow Jones, because what they were hoping for was that the economy would be weak enough for the Federal Reserve to shift from rate hiking to rate cutting by mid-2023. So a strong jobs report was supposed to send the market down, but it didn't. It did like nothing. Here was the S&P on Friday. It was down 0.16%, or it was basically flat. It did nothing. The NASDAQ was basically flat. It was down 63 points, down a little bit more than the S&P, but still not bad. If you look at the Dow Jones, the Dow, which was what they said here would deliver a jolt to the Dow Jones, the Dow Jones was actually up 76 points for the day. My own portfolio was up for the day. And then also what was pretty bullish to me is on that day, AMD was down, yeah, but they were down $1.60. If you look at NVIDIA was down, yeah, but it was only down $2.26. I know from having owned these stocks for the better part of 2 years, when bad news comes out, man, NVIDIA gets smoked. I mean, it would be nothing for NVIDIA to go from like $190 down to $170. Like that's just kind of the way it works. Bad news, NVIDIA gets hammered. Same with AMD. Another reason why I know retail is back and then I'm happy about it is you look at Coinbase here. There is nothing positive surrounding this company. Yeah, Larry Fink and BlackRock have taken a stake on it and said, yeah, you're going to go ahead and be able to trade crypto using Coinbase through our exchange or whatever. But that shouldn't have been enough to pump this stock 52% in the last week. Folks, this is retail taking charge and people are getting squeezed. I myself bought a put against Coinbase, but I'm more than happy to let my $280 go if it means that my AMD and NVIDIA stock are going to rise. And the third reason why I'm so bullish on this market, believe it or not, is housing. And hear me out on this one. I realize that the housing market is slowing down, that the cost of houses is going up, but a lot of places they're having to trim their price of the house just to sell it. People are concerned that mortgage rates are going to spiral out of control. There are people out there that are having to surrender their pets due to the high cost of housing. They got rents that are hitting record high after record high, and that has a lot of people concerned, and it should. But there is a limit to how much you can rent a house out. You know, if I could rent my house out right now for $10,000 a month, I would do it. But of course I can't. And why can't I? Because no one's going to pay that. So there is a limit to how high that you can raise your rent. Also, existing home sales, even though it's 5.1 million, it seems like, okay, housing is slowing. Sure, it's down here from 2020, but it's 5.1 million is historically a pretty good number. So our housing market, though it is slowing, is not, say, dead. I mean, we might be going back to a time where you list something, say, for 300,000 and somebody offers you 290 for it and you take 295, but is that so bad? That's the way it's always been. It's the last 2 years that have been the total irregularity where you're having bidding wars over everything. I think it's okay to pay a fair price for a house. And can the mortgage rates just spiral out of control? Well, I'm sure that they can, but let's go ahead and look at the data here. So we can see that the 30-year fixed seems to follow the 10-year treasury yield very, very closely. Where the 10-year treasury might be at 2 here in January 13, the 30-year fixed was at 3.3. So that would be a difference of 1.3. And then if you look at it right here, let's see, in September 18, 3.05. And then this one would be 4.52, so difference of 1.5. Right now we're getting fleeced, okay? So someone's got to do something. Come on, if you're listening, banks, stop doing this to us. So right now the 10-year treasury was at 2.68 and the mortgage rate was 5.3, so that's a difference of 2.7. So on a historical measure, we're getting slaughtered. The only other time that we've been this bad was during the housing crisis back in 2008. But other than that, this is a really wide disparity, and we would expect this to probably get a little bit closer, come more to like a historical level. And so we would say if the treasury yield say at 3, we wouldn't expect this to be any more than 5. So I think that the fixed rate needs to come down a bit to mirror the 10-year bond yield. Now, why wouldn't the 10-year bond yield just spiral up out of control and take the 30-year fixed mortgage with it? So if you look at 10-year treasury yields across the world here, you can see that the U.S. yield right now is about 2.83, which is higher than Canada, but less than Brazil and Mexico. Now, let's just say, for instance, the U.S. one pops up around 3.5 or even 4. Well, so 3.5, we would be higher than everybody except for just a handful of countries. Let's see, Germany's at 0.95, UK, Italy's at 3. We would be higher than basically everyone except for India, Brazil, and Mexico. So what's happening is that every time our 10-year yield tries to creep up over 3.5%, it's being driven down again because all of these different countries are buying our bonds. And as patriotic as they want to be, Japan isn't going to buy their own yield at 0.16%. They're going to buy ours, and they know they're going to be paid back for 3.5%. And in fact, Japan is our largest holder of foreign debt. So if the 10-year treasury is not allowed to go above 3.5 because people keep on buying our bonds, how can the 30-year mortgage spiral out of control unless, of course, the banks continue to fleece us the way they seem to be doing right now? Shame on you. Now I look at that, that really is repulsive. Hopefully they fix this pretty soon. All right, so the fourth reason why I'm so bullish on this economy has to do with earnings. Our earnings are coming in this quarter very, very nicely. The earnings scorecard is showing that after 87% of the S&P 500 companies have reported, 75% of them have reported positive surprises on their earnings per share, and 70% of S&P companies have reported a positive revenue surprise. So this is showing that all is not horrible in the world right now with respect to our companies' earnings and revenue. We're also showing earnings growth of 6.7%. If 6.7% is the actual growth rate for the quarter, it will mark the lowest earnings growth rate by the index since Q4 of 2020. However, it is still growth. So we're talking about a shrinking GDP, but we're talking about an S&P 500 that is having earnings growth of 6.7%. I'm not exactly sure how this is working out. The guidance, of course, has been weak. And why would you report good guidance right now? Because you get no bonus points for good guidance and you're not really penalized for poor guidance. Let's take a company like Kulik and Sofa right here. Year to date, they're down 22%. When you look at their financials, every time they report, they're giving out these gigantic earnings beat. The last time they reported this past week, they had their earnings surprise of 31%, and the quarter before that was 33%. And a lot of this is because they're sandbagging their forecast, because if you're already down 23% or whatever it is for the year, what are they going to do if you have a 35% surprise and you give a bad guide? Sink you down to 24%, 25%, but if you report a great earnings guidance, you're still down like 20% for the year. So what's even the point? Just give bad guidance, and that's what a lot of companies seem to be doing right now. So the forward 12-month PE for the S&P 500 is currently sitting at 17.5. This is below the 5-year average of 18.6, but above the 10-year average of 17.0. If we look down at this chart here, the light blue line is actually the price of the S&P 500. It's correlating along this here y-axis. And the dark blue line is the price per share, sort of a metaphorical price per share. So if we look at here, it's sitting at roughly, like say, 238. Break out a calculator, 238, and it's trading at 17.5 times, then that would give us an S&P about 41.65, and the S&P is currently trading at 41.42. So our numbers are pretty close. So there are a lot of pundits out there that think that the S&P will trade around $240 at year end, and a lot say 230. We can go ahead and split the difference and call this 235. But what's the right multiple? Well, we just showed here that the 10-year bond yield can't climb above, say, 3.5%, or really 3%. And so when the 10-year bond yield is sitting at 3%, the stock market returns look a lot more attractive, which drives up the price to earnings ratio of the stock market. So I don't think a 20 price to earnings ratio is completely out of bounds. However, let's go ahead and play this conservatively, and we'll say that we get a 19 price to earnings ratio, and we're trading at, say, 238 times like we are now, times 238 will give us an S&P 500 final score at the end of the year of 45.22. So we would expect the S&P to climb about another 400 points from here by the year's end. And that's the camp that I'm in right now. I think that the S&P is going to go up, and I think that 4,600 seems perfectly reasonable to me. So earnings and low bond yields would be the fifth and sixth reason why I'm so bullish on this market. Now, the seventh reason why I'm bullish on this market has to do with falling commodity prices. If you look at the copper futures here, they're falling off a cliff. They went from $4.73 in April down to $3.55 today. If we look at lumber, it's gone from $1,400 in March down to $479 today. If we look at corn over a year here, it's gone down from $744 in July to $609 today. If we look at wheat, it's gone down from $1,277 in May to $776 today. And perhaps most important of all of them, let's look at oil here. It's gone down from $120, $122 in June all the way down to $88 today. And as the price of oil comes down, it's going to make a lot of our transport stocks a lot more attractive as their margins actually increase. Companies like FedEx, UPS, XPO Logistics, JB Hunt, Union Pacific, CSX, a lot of our other airlines, Delta, United, Southwest are going to be a lot more attractive. Just things in general, just like if they have stuff delivered to you, it's going to be a lot cheaper to get inventory into your stores. And on the subject of inventory, another reason number 8 why I'm bullish, now that I think about it, is that companies like Target and Walmart, yeah, they have this glut of inventory that they've piled up. However, the worst I feel like is behind them. They're not going to continue piling it up and piling it up and piling it up. They're going to try and figure out a way to get through this inventory, and they're doing it by putting on a lot of sales and slashing prices, which is going to also help decrease inflation. And I do feel that a lot of the retail worries out of companies like Target and Walmart are going to be behind them, and they have better days ahead. Now, it's going to take them some time to work through this excess inventory. It's not going to be like flipping like a switch, but it is going to be something that they'll eventually work through, and I do believe the worst days are behind them. Now let's go ahead and look at gasoline demand right now. You can see that the gasoline demand in the United States has gone down significantly from 2021, 2022, as opposed to 2020 and 2021. There's just a lot less demand for gasoline. That's helping drive down the price per barrel of oil. I think interesting on this chart is that when you look at the demand for oil per region in the United States, to me, it's very interesting. You can see here's the conventional gasoline stocks in millions of barrels. And then US will say here in July of 2022 would be 17.2 million barrels. The East Coast would say we would need 2.5. The Midwest, 4.4 million. The South needs 7.2 million. The Rocky Mountains need 1.1 million, and the West Coast needs 2.1 million. I can see the Midwest because there's so much distance between, say, your work and home, or just like they drive a lot of miles in the Midwest. I can see that one. The South is a little bit more confusing to me. Maybe it's just like bigger cars. I don't know, but they do seem that they do use up a lot of gasoline down there relative to the rest of America. Now, when we look at auto sales, we can see that they dropped 11.7% in July. But let's go ahead and just have a look at this chart because it makes it a lot easier to understand. So between 2022 July and 2021 July, we can see that there was a drop of 11.7% year over year in the month of July. If we look at it January through July of 22 versus January through July of 21, we can see that there was a year over year difference of negative 17%. We're selling a lot less cars. So if you look at here though by manufacturer, we see GM is down 16%, Toyota is down 19%, Ford is down 3%, though year over year they are up 36%. Making Ford a pretty dang nice stock, if you ask me. They have a lot of good vehicle offerings. They got the Ford Mustang Mach-E, they've got the 150 Lightning, the Bronco, the Maverick. These guys are a pretty exciting car company at the moment. But I digress. Okay, so year over year, you can see Stellantis, whatever that is down 13%. Honda is down 40%. Hyundai down 13%. And then all of a sudden, you look down here at Tesla, up 71%. Subaru's down, VW is down. They have a pretty good EV selection. Where they? Okay, they're up also because the ID4 is a really nice car. Let's see, Mercedes is down 2.2, BMW is down 7, Mazda down 25, Audi 27, Volvo 23, Porsche is down 10, Mitsubishi 14, Land Rover's down 41, Mini is down 19, and then we look down here at Polestar. They're up 1,200%. Now, granting this is a pretty small sample size, 356 cars sold in 7 months last year versus 4,663 this year. But nevertheless, we can see that this is a company on the rise. And again, they're an EV player. That's all they sell is electric vehicles. So we can see that people are finding EVs to be very attractive. And actually, now that I own an EV, I think that the oil prices spiking the way they have, driving people from combustion engines to EV engines is going to be a huge mistake on the part of the oil company, because I'm telling you, as a person who now owns an EV, I will never buy another combustion engine car again, not if I can help it, because of the acceleration, the performance, the convenience of just charging it up in my garage and having a full tank the next morning. And of course, all of the technology that comes with the car. And I know that Ford has a lot of good technology as well. Then a lot of the combustion type cars are catching up. But why, if you have this car, which I used to think was kind of gimmicky and I would get like range anxiety, why would you ever buy a combustion car again? The price of oil going up is a huge mistake for oil companies, but that's just my opinion. If we look at the Polestar coming out here in October of 2022. That's when the Polestar 3 will come out. It's kind of like what they're considering it is kind of like the Porsche Cayenne. It's going to be the EV version. It's getting 372 miles to a charge. The price is going to be roughly $75,000. The year after that, we're expecting the Polestar 4. No one really knows what that looks like yet. It's going to be akin to the Porsche Macan. It's going to be the cheaper version of this. So they're going to put out this one. It's going to be more expensive. And then, of course, they'll put out the Polestar 4, which will be a bit more affordable, though I'm sure very expensive. I am very bullish on Polestar. Drove one. I like it. It's a nice car. It doesn't have quite the zip of the Tesla. When you look around the interior, it's kind of more like an ordinary sedan. So it looks like it carries a little bit more weight, which takes away from some of the acceleration and the high performance. However, I really did like the car. And I am bullish on the company, but when push came to shove, I think with like a lot of other people, I went ahead and bought a Tesla just because of the the charging network. And I know I can go different places. Like if I want to drive to here to Boston and I need to charge it on the way, I know it can be done, and it can be done in a hurry. And so, and also there's the track record of reliability. The other reason why you want an EV is there's less maintenance, except for like maybe tires, because those things take off so quickly. Maybe you're going to burn through tires, but you're not going to burn through an alternator, and you're not going to need to do oil changes. I mean, they're just a fantastic car. But based on my personal experience, I'm sorry, but the combustion engine does seem like it's going to be kind of like a thing of the past in the next 10 years or so. And before we continue on to my final reason why I'm bullish, need another message from my sponsor, beer. This one has a good taste too. All right, so my last reason, the ninth reason why I'm actually bullish, has to do with the VIX. So if you look at the VIX, we've been in this perpetual state of anxiety for like the better part of 2 years. And if you actually like average this out over 2 years, it would have to be the highest 2-year VIX in the history of the stock market. And people are saying, well, we can't actually hit a bottom until we fully capitulate and this thing spikes up. Well, wouldn't like a slow, steady pounding for 2 years count as maybe one spike up? As a matter of fact, I'd rather just have a spike up, get it over with, and come back down to earth. Like right now, our low is what used to be the highs. This is what we're dealing with, and this is what we've been accustomed to. I think that this VIX eventually will come back down to where it normally lives in 10 or 11. A lot of us don't even know what 11 feels like. For us, good is like 20. 20 is low. Yeah, look at how low that is. But this is what we're accustomed to. And I think the day will come when it will actually come back down. Now, our options will not trade for as much money, but I don't care because my actual underlying equities will tick up with time. Well, let's get into the reasons why I might be bearish on the market at this time. Well, number one has to be inflation. This entire market is just so dependent upon this inflation data that's going to come out on August 10th at 8:30 a.m. If it comes out really hot, I'm afraid the market could crash and my entire bull thesis, I could just throw it down the drain for now. It's expected to come in at 8.7%. An inflation read in the 9s, or God forbid the 10s, would really make this market crash. But if it surprises to the downside, say it's in the 7s, they would make the market go straight up. I wouldn't expect all that. Now, although that commodity prices are coming down, and you would think that would have a very positive impact on net earnings for companies, and that would be correct, the hourly wage growth does seem to be going up more than people are expecting. This month was supposed to be like 4.9. It came in at 5.2. And though it's not astronomically high, it's still a lot higher than it was, say, in April of 2021. And so this is something that they might think we have to get this under control in order to really control inflation, because if people have more money, it's going to be awful hard to bring inflation down. And the next reason why I would be bearish is when they release the FOMC minutes. of the last meeting that they held on July 26th and 27th. When analysts actually read these minutes, they may not find them to be particularly dovish. This U-turn that they're hoping for might not actually read as well as what they heard. Like the things that they heard in their ears may not read the same with their eyes. And when they see this, I'm just afraid that suddenly everybody's going to get a little bit more paranoid. They haven't released the data, it doesn't appear, about when they're going to release the minutes of the last FOMC meeting. But when those minutes do come out, I'm afraid that it could be a pretty bearish moment. And my last reason for being bearish on this market would be, what if people just stop believing the GDP prints? Like, what if they think we're not in a recession at all? That there isn't really a slowdown, that housing, we're still selling plenty of houses, restaurants are full, bars are full, people are traveling, people are spending money, earnings are good. Somebody's going to say, hey, why don't you guys just go ahead and look over your math again? Maybe you didn't carry the one or something like that, but we don't believe we're in a recession and we don't even think your numbers are correct. And for that, they're going to get scared that the Fed might start hiking rates up again for that reason, for fear that the recession rumors are incorrect. Like, I'm actually hoping that people do believe these GDP prints in spite of all this good employment data and company earnings. But these are something that could cause the market to reverse if people just suddenly stop believing the GDP numbers. All right, that's all I got for today. If you got out of this video, yeah, please like, subscribe, hit the little notification bell. Until then, we'll see you next time. Have a good day. Bye.